Hey, what's up, Super Stock Bros? My name is Ace, and today we're going to be talking about what to do in this market climate as everything seems to be crashing down to earth. How can we still make money from this? Stay tuned. Okay, so first let's go over our swing bullets just to see what our portfolio is looking like. And yes, it's not looking pretty, but again, we're in a downturn and we have the patience to outlast the market here and we will recover. So there's no doubt about that. Now, we did buy IPOF warrants at 473. Of course, that price has come down to about $3, but that's okay. It's not too bad, especially because I'm still confident in our logic, which is we have Chamath as a leader, although he's been taking a little heat for selling off space, but I can't really blame him. He has more shares in the company in actual corporate funds. Besides, he needed to diversify, which is fine. You can't hold someone to hold those stocks forever, right? But with IPOF, I'm still looking for a good target, and even if they don't get the target and IPOD gets the target, then I think we're going to see an upsurge. I don't know if we're confident about the target hitting 639 anymore, because that would be a straight up double up, but as soon as we see that influx, that's when we'll be looking to sell. We want to hit the peak, and then we're just going to sell off unless we really like the company that they're merging with. So that's the target. In terms of the warrants, again, same thing. Now, this is the SPAC Road to a Milli bullet, so I am sticking with this strategy no matter what. I might not achieve 150% at this point just because of the same logic I just said. It kind of came down a little bit. The whole SPAC market is in risk-off territory, so a lot of people are staying away from putting more investments in, which is totally reasonable. This is not the type of market climate where you want to be taking too many risks. You might be taking out your money for, your new mortgage interest rate payments, which is totally reasonable. And I think a lot of retail investors are doing that. But again, still bullish on the market overall, still bullish on the SPAC market. And I do think that everything will come back up. And actually, we did see a little bit when the market fell. We saw that the SPAC market did come up a little bit, and it was like a 20% increase across all of the boards. So that actually instills a lot of confidence in me, because I know that when there's going to be an upsurge, it's going to be huge for the SPAC market. So keep an eye on the SPACs that you like. A lot of them are near net asset value. Like usually it's around $10 for most SPACs. Some of them are $20 like Pershing's. But when it's near $10, that means you can get pretty much maximum value. So look for those SPACs. If you're still confident in the SPAC market, then this is the time to get in. I'm still confident in it. I think if you invest at net asset value, you're going to see at least a 20% rise probably with a lot of the SPACs you invest in, but that's not guaranteed, of course. Like for instance, there was one, I believe is RMBG recently, that only went up like 8%. But you know what? That's still a great return for all things accounted for. Now, in terms of our portfolios, yeah, we have a lot of red here. And I finally did the additions properly over here. So we do have 11,000 that we're swinging around with. Now, again, both these values are values that I'm willing to lose 100%. So if you're following me, follow at your own risk. I'm willing to lose this 100%. And as you can see, I've lost a lot of it. But like I said, I'm confident that the SPAC market will make a resurgence here. So, and I know that, you're seeing this on a sheet. You might be thinking, this guy still doesn't have it. Here's my account. I have, this is just my Interactive Brokers account. And here I do have the 830 position I started with. It was up a decent bit. It was up, I think, $2,000 at one point. Now it's only 1,158 negative. So that market value is 2,500. So it's still not too bad. Okay, and looking at our play tracker that we haven't really updated in a while because there haven't really been plays made. We did have that CCIV explosion, unfortunately. I got burned really badly from that, as we saw in the portfolio section. And I'm afraid many YouTubers and their followers got burned pretty badly as well. Essentially, the deal was not very good for the investors that were in pretty late. Like if you bought around the 50s and the 60s like I did, then you got burned pretty badly. I mean, I was lucky that I had bought prior to that level around like 30 and I made some cash to offset that, but overall I'm negative. That's okay. I think eventually it'll come back. This is a long-term play now, but but I think Lucid does have a pretty great chance to actually come back to that price if you hold it. Unfortunately, you have the opportunity cost of actually having to hold it, but I leave that to you. Now, I do have Bridgetown. I'm still holding that, and I do think that these are great prices. If you notice here, I'm saying below $11 is great price. Net asset value is 10, so you'd be only risking 10%, which is okay. Pershings, again, it's getting close to the buy level that I recommend here during this downturn. Before I was recommending anything below 30, and now I'm saying below 22 because it might actually fall to that level in the near term, especially with the bond yields going up, the interest rates forcing cash to flow out. But we'll see about that. IPOF, I'd say below $2 is a good buy just because the stock price itself of IPOF is around 1180-ish, which means that you could actually buy the shares itself, and you would be having a great deal there. You would only be risking about 11, like around 12%ish. So you could definitely do that. Ajax, this is actually a great buy right now. If you believe that the SPAC market is going to come back to life like I do, and when the SPAC market comes back to life, I think Ajax is a great buy. So my target for that is 15, and that's about a 50% increase. I'm actually thinking about this. Unfortunately, I don't have the cash to go around right now. Once I get the influx of my monthly budget coming in, that's when I'll add more to that position. So as we know, the market climate is pretty brutal right now, and you might be wondering, what do you do in this situation? Well, it kind of goes back to budgeting and what you can actually do with the cash that you have on hand. So first of all, a lot of people recommend that you should keep at least 20% of your portfolio in cash for moments exactly like this. When you're waiting for the dip to stop falling, you're hoping it'll finally bottom out, and it will. And then you can put in cash into shares that you prefer to buy for the long term. And that's what I recommend first. I talked about it in my risk video. I talked about it in a couple of other videos. But always think about your long term first. Don't try to do gamble plays. You might get lucky. You might follow the right trend, and then you might hit it. Yes, but generally that's not the type of win you're looking for. That's kind of like going all in poker with any two cards and winning and being like, oh, I won the game. No, you didn't win the game. You played badly and you just got lucky. So you don't really want to do that. What you want to do is you want to build up your long-term portfolio in a smart, consistent way, which is something like, okay, of the 20% you keep in cash, you have the 80% as your long-term portfolio, or you do a split like 80% of that 80% is your long-term, and then you can play with 20% for these swingy type of plays that are more on the risky side, or 90% long-term and then 10% on the swingy play side. So that's something like what I'm doing. I'm doing an 80-20 and then 20% cash on the side so that I can put it in. It's a lot of numbers, but basically it's to say that you should diversify properly, and you should always think about your long-term first. So what am I doing in this particular climate right now? Well, let me show you. So in this climate, I'm looking at selling some naked calls. For example, I have a lot of Palantir shares. I'm bullish on Palantir for the long run, but in the short run, they've been getting hit hard because it's for some reasons, considered a meme or speculative play. I don't think so, but at the same time, I'm willing to capitalize on that misconception. So I sold a lot of naked calls and covered calls because I do have over 700 shares, and I'm just selling covered calls on those shares. And actually, I did mention this is another high IV play. A lot of implied volatility means that you get paid more premium for selling those naked calls, okay? So I'm like the casino, selling the options to people that are risking their money, hoping it'll shoot up in the short term, which I don't think is the right market climate for shooting up these kind of stocks. I mean, I hope so. I own the shares. It's a win-win situation for me, right? But in this case, I'm profiting from the short term, and I'll show you how much this is actually profiting in the short term. Now, beyond that, I was looking to expand my long-term portfolio. Now, I did post this in the Discord, which is all of the stocks I am looking at currently, and I posted it below here, so you don't have to scroll into this tiny text. So I bought some NEO shares for the long term, and I bought some Square shares for the long term. I didn't mention it here, but I had 100 NEO shares, and I bought 30 Square shares. Now, this is a scale-in. And what I mean by that is, yeah, I have this dry powder on the side for this particular situation, but I don't know when it's going to stop and bottom out. So what I'm doing is I'm buying on each particular dip on, you could do it like every day or every other day or every week. I chose a particular day and I bought some NEO shares. Actually, this came up a little bit. I was up 15% at one point, and now it's down. It's actually in the negative. So scaling in reduces your risk that all of a sudden the market just pop off and leave you behind. I'm trying to avoid that at all costs because it happens very frequently in this type of very erratic market. So that's it. I'm building up the long term during this unfortunate market climate where everything's coming down and it's seemingly never going to stop. This is a very pivotal week, so tune in. I'm going to give a market update later on in this week, and in the Discord chat, I am constantly updating the members for free. And I just want to say that I'm waiting for this market climate. I want to see the upturn. I know for the fact the market is going to recover. I just don't know when. And when it does, it's going to just keep shooting higher. That's always been the pattern in the past, and that will continue to be the pattern. So the worst thing that you can do is panic and sell at these lows, and then try to play it, try to be smart and buy, sell at the highs and then buy at the lows. Yeah, you want to do that, but it's very hard to do. Just stay in your stocks, wait for them to come back up. And you also have to think about from another perspective, which is the tax perspective. Like, for example, if you don't hold the shares for a year and you're just swinging them back and forth, you're going to be taxed pretty heavily. So just think about that as well. So I mentioned that I'd be showing some of the gains from the covered calls and the plays that I was making, even in this down market. So I have 7 covered calls here for the Palantir shares that I have. I sold them as a hedge in case that the market fell as bond yields were going up, and I was right. So what happened is I'm collecting 60% of those covered calls already, and that's already making me $900 on my 700 share investment of Palantir. Okay, so that's you're getting a decent 8% on the amount of money I put in originally, and I'm going to keep doing that over and over until I feel like the market is going to pick up, and then I'll judge whether I want to sell these covered calls at that time or at the new highs, or just not sell them at all. And then finally, let's quickly go over the list that I'm looking at. For the long-term plays, I'm looking at Airbnb, AMD, ARK, BIDU, Etsy, FUTU, which is a great Chinese financial stock. It's almost like the Square competitor in a way, or Robinhood competitor. So that's great stock. JMIA, which is the Amazon of Africa. You have NEO. NVDA, which is getting overlooked a lot, I'm noticing, and so is AMD. So I'm watching these two very closely. Palantir I love. I have over 1,000 shares, so you know what I'm doing with that. I'm going to be piling on more to the long term, possibly, but I also want exposure to Square and ROKU because I love these two stocks, and we saw the power, the explosive power that they had as they rose above. ROKU almost hit over 500, and Square was almost hitting 300 at one point. So still watching these guys. Tesla, of course, loading up at these lows. I'm still waiting for it to see what the bottom is, but I love this stock, and obviously I'll get more if I can get my hands on it, basically. Wayfair, it's actually high at these levels, but I've been watching it very closely. If it dips more, then I'll buy some of it, but actually it already rose up about 20% in this pre-recovery phase. And then you have more volatile stocks. AMC, of course, one of the Reddit stocks, along with GameStop, right? And then you have Mara, which is more on the crypto side. So Mara and Riot are very interesting because they are actually crypto stocks, and the crypto market is stronger than ever. So it's very interesting to see the dynamics here, because even though the stock market is falling, and that means shares are falling, of course, crypto is going up. So these are actually undervalued at this price. And Riot should actually go up to about 90, I was expecting, and Mara to about 60. So this is very interesting to me. These are very undervalued. But of course, they come in with high risk because they will only go up in a very bullish market. But when they do, they're going to explode. So I'm watching these very closely. Maybe I'll add them to the swing portfolio. And then, of course, we have our SPACs. And I'm laying off the SPACs for now just because they take a bigger hit during these down days. So as you can see, ACIC, which was, getting close to 20 at one point, just got cut in half. I think it's a great stock, but not in this climate. CCIV, of course, we know all about. Curie somehow is holding up. This is the curiosity stream. So very interesting. GHVI, I'm very interested in still. This is the Matterport SPAC. And it still has a lot of clout with Meet Kevin, for instance, talking about it, etc. So I'm still watching all of these. And of course, you know about the main ones that I always talk about, Ajax, BRPA, Bridgetown. You have the Goldman Sachs SPAC. You have IPOF, and you have the Pershing Holdings. So you can see that these are down heavy. This is not the right climate for SPACs, but like I said, very bullish that it'll come back up. Okay, so that's it for me, folks. So just to recap, in this market climate, you don't have to just sit on your hands, but use your dry powder when you feel like the time is right. Scale in. You don't have to put it all in at once. Otherwise, you're risking too much of a mistake on one particular point in time. And usually that results in a mistake either way. Like, you can't time it perfectly. So spread your bets across a particular time period. Try to build up your long-term portfolio while things are cheap. And see what you can do in general about building up your position long term. This is really a time to perfect your budgeting. Budgeting and timing are, key to all of this. Now, understanding the market climate for SPACs, for instance, is also an important thing, which means that you might be seeing everything come down, but do not panic and sell, because these things will come back up as fast as they came back down, right? So just watch out for that and have faith in the market, because it always recovers. So keep your money in, let it ride out, and don't sell for a loss if you can help it. But at the same time, understand your stop losses, your mental stop losses, and see what you can manage on your personal basis. None of this is financial advice, but that's how I'm playing things, and I hope you learned something from what I'm doing. And stock bros, remember, we will make those gains.